Today we are going to discuss global financial crisis. What is a financial crisis? A financial crisis is a situation wherein the values of financial assets fall rapidly in an economy. It is a situation in which the demand of money outstrips the supply of money. Implicit in it is the liquidity quickly evaporates from the system due to disproportionate withdrawal of money from the bank by investors. The situation gets confounded when depositors withhold themselves from depositing due to some kind of a fear that the banks might collapse. Consequently, it leads to the financial crisis. The financial crisis leads to an economic crisis, a situation in which an economy of country experiences sudden downturn. An economy facing such a crisis is most likely to experience falling GDP, liquidity crunch, scarcity of cash in the economy, rising and falling prices due to inflation and deflation. Economic crisis can further deteriorate and become recessionary in nature or could lead to depression. It plagued by contagion. Empirics all over the globe show that the financial crisis is associated with banking panics because people lose the faith in the banking system. Financial crisis of 2007-8 is called the global financial crisis since most countries in the world were affected by this crisis. It began in 2007 with the crisis of subprime mortgage market in the US and developed into a full-blown international banking crisis with the collapse of the investment bank Lehman Brothers on 15 September 2008. It was because of excessive risk taken by banks combined with the bursting of the United States housing bubble. It caused values of security tied to US real estate to plummet, damaging financial institutions globally. This culminated with the bankruptcy of Lehman Brothers on September 15, 2008 and an international banking crisis erupted. Massive bailouts of financial institutions and other palliative measures and fiscal policies were employed to prevent a possible collapse in the world financial system. The crisis caused severe contraction of liquidity in global financial markets that originated in the United States as a result of the collapse of the US housing market. The stock market all over the world collapsed, financial bubble bursted. Currency crisis is also a very important part of financial crisis. And of course, the sovereign default occurred due to this crisis. The crisis in the banking system of the European country using euro followed later. Commercial banks across the globe suffered from a sudden rush of withdrawal by depositors. And it is considered by many economists as one of the worst financial crises after the Great Depression of 1929. Reasons for financial crisis are 2008. The Federal Reserve, the central bank of the United States, having anticipated a mild recession that began in 2001, reduced the federal rate, the interest rate that bank charged 11 times during May 2000 and December 2001 from 6.5% to 1.75%. The significant decrease enabled banks to extend consumer credit lower prime rate and encourage them to lend even to subprime or high risk customers though at higher interest rate. Consumers took advantage of the cheap credit to purchase durable goods such as appliances, automobiles and especially houses. The result was creation in the late 1990s of a housing bubble, a rapid increase in the house prices to levels well beyond the fundamental or intrinsic value of the houses driven by excessive speculation. In essence, the causes of financial crisis include relaxation in lending regulation without doing due diligence of objective and professional assessment of borrowers, credit worthiness and repaying capacity. Rising EMI due to high interest costs constrain the borrower to pay back to banks. The subprime lendings are characterized by higher interest rate, poor quality collateral and less favorable terms to cover for higher credit risk. So lending decision by financial institution and borrowing decision by individuals led to housing bubble formation. Basically, the housing bubble burst in the US is a case of subprime mortgage crisis. It so happens that many a times one borrows too many times and repays to build rapport with and convince bankers about one's credit worthiness. Every time he borrows more than the previous time and finally he becomes a defaulter. Impact of the subprime crisis. Some major impacts of the global economic crisis included major banks suffered huge losses. Lehman Brothers went out of business and collapsed. Merrill Lynch had to sell itself to the Bank of America for a fraction of its value. Countrywide Financial Corporation, the biggest US mortgage lender, eventually was taken over by Bank of America. It led to job losses, higher incidence of poverty, reduced consumer spending, low GDP growth. Was India insulated from the global financial crisis? The answer is categorically no. World is interconnected. In spite of the fact that India is not well integrated into the financial markets with other countries, India was also impacted by the crisis. As a result of this crisis, India's growth decelerated to nearly 6.7% in 2008-9. This represented a decline of 2.1 percentage point from the average growth rate of 8.8% in the previous 5 years. Checks and balances in India. India has institutionalized the financial discipline by enacting the Fiscal Responsibility and Budget Management Act 2003, that is called FRBM 2003. This was a piece of legislation enacted by Parliament in India with an objective to reduce India's fiscal deficit, improve macroeconomics management and overall management of the public funds towards a balanced budget. And it gave additional support to the exporter. In essence, India went to a massive stimulus target. RBI took 5 important measures to reduce quantum of bank reserves and maintain a comfortable liquidity situation in the economy. Second was to augment foreign exchange liquidity. Third is to maintain a policy framework that would keep credit delivery on track so as to arrest the deceleration in growth. Fourth was to reduce policy interest rates aggressively and rapidly. Fifth one is expand and liberalize the refinance facility for export credit. Effect and aftermath of the crisis. To sum up, failure of 168 years old investment bank Lehman Brothers with 639 billion US dollar in assets created lasting turmoil in financial markets worldwide. It severely weakened the portfolio of the banks and fostered new distrust among banks, leading them to further reduce the interbanking lending. In 2012, the St. Louis Federal Reserve Bank estimated that during the financial crisis, the net worth of American households had declined by about 17 trillion US dollar in real terms, that means adjusted for the inflation. Approximately 7.5 million jobs were lost between 2007 and 2009, representing a doubling of the unemployment rate. Although the economy slowly added jobs after the start of the recovery in 2009, many of the added jobs were lower paying and less secure than the ones that had been lost. Those who had suffered the most were millions of families who lost their homes, business or saving. The millions of workers who lost the job and faced long-term unemployment. The millions of people who fell into poverty continued to struggle year after the worst of the turmoil had passed. Their situation was remarkably in contrast to that of bankers who had helped to create the crisis. No American CEO or other senior executive was even prosecuted on criminal charges, in stark contrast with earlier financial scandals such as saving and loan crisis of 1980 and the bankruptcy of Enron in 2001. In general, the key lenders of financial firms as well as other wealthy Americans had not lost as much in proportional terms as members of the lower and middle class had. And by 2010, they had largely recovered their losses while many ordinary Americans never did. The visible disparity naturally engendered a great deal of public resentment. Political and economic system seemed to serve the interests of very wealthy, the top 1% as opposed to the bottom 99%. This flags the issue of economic inequality in the US too and demands an answer to the question, whose priority counts?